Have you heard about this guy who donated $8 million to charity when he died? The surprising thing is not his donation, but the fact that he was a janitor, with average janitor income. That's right, Ronald Read was a janitor. He did not inherit any money, he did not win a lottery, but he ended up with $8 million? How? This is one of the well-known stories from Morgan Housel's book, Psychology of Money. During this video, I will tell you about 3 of the most powerful but fairly dumb money principles from Morgan's book. Now, why do I call them dumb? Because they are so simple that by the end of this video, you will kick yourself for not doing them and becoming a millionaire till now. Trust me, this is going to change the trajectory of your finances forever. And also stick till the end because I have a special bonus tip for you that will save you hundreds of thousands, if not millions. So listen up carefully. 1. Principles that apply across the board. Let's understand this with the lives of 2 childhood friends, Warren and Bill. They grew up together and even went to the college together. Their families were your average people. Warren was good at studies. He understood the principle that if you work hard, you get results. As simple as that. So when he studied, he got good grades. When he went to gym, within a few months he had good gains to show for. Bill, on the other hand, was not very ambitious. He was an average guy, not exceptionally good at anything, but not worse off at anything either. When both graduated, their life trajectories diverged for the first time. Warren, being a lot more hardworking, got a high-paying job in a popular technology company. Bill started as an average, or slightly below average clerical position in a company. Warren was also earning nearly 1.5 times of Bill. Warren lived his life. He worked hard, but partied harder. He knew he had a good career ahead of him, so he was carefree about money and immediately bought a brand new expensive car on monthly payments. He also chose to live in an expensive apartment because his peers were living in similar kind of apartments. He also went out on trips, ate in restaurants, bought stuff, and generally chose to enjoy his money in life. Bill, on the other hand, was just getting by. When they finished their first year of job, Bill understood that he won't be able to sustain himself and his future family with the way things are. In his desperation, he started seeking answers to his money problems. He found a lot of advice, from get-rich-quick money schemes to starting his own business, but he also recurrently saw people talking about regular savings over time to get ahead. He went deep into a lot of things and realized that most of the money-making schemes and businesses do not pan out well. Even low-cost and low-risk businesses also have a high failure rate. He was not a big risk taker. By chance, he also stumbled upon Morgan Housel's book, Psychology of Money, and came to know about the magic of compound interest, so he decided to invest a little bit of money instead. So he started living below his means, he cut down all non-essentials from his life, and started saving and investing 20% of his money in a low-cost index fund. It was hard at first, but soon he got used to living on a leaner budget. Time rolled by. Soon 4 years passed. Warren was in town, so he decided to catch up with Bill. They both met for a coffee, and the conversation drifted towards career and money. Warren proudly bragged about his new house in an upscale area, his new swanky car, his branded clothes, and his high-paying job. Bill, on the other hand, told him about his modest and decent life. Warren was shocked. He knew that Bill was not earning much, but he should not be that destitute to live so mediocrely. Bill explained that the reason why he does not go for these things is because he is planning for his future. He is investing money. Warren was very disappointed that Bill was trading his life's prime years for these pointless things. He advised Bill that investing is for the rich, and he should not downgrade his lifestyle for a few $10,000 or $20,000, because that's what Bill's savings have amounted to by that point in time. But Bill tried to reason with Warren and tried to explain compounding. Warren was not convinced. They dropped the matter, and their conversation moved to something else. Soon, 15 more years passed. Warren's and Bill's lives changed quite a bit. Both were earning more than they used to. Both got married and moved up in life. During these years, Warren did read a bit about investing after coming back from Bill's place those 15 years ago. He also tried a bit and soon realized that even in 1 year, his investments haven't grown that much. He figured that even if he got this kind of return throughout his life, it would not amount to much. So he quickly gave up the idea of investing. He was then finally convinced that investing is pointless, especially when he can switch a job and increase his pay more than he can ever earn from investing. Bill took his family on a trip and by chance passed through the city where Warren lived, so they again caught up. Warren was happy that Bill listened to reason and stopped living like a miser. He saw that Bill was living well off now. Bill and Warren talked a lot and the conversation again drifted to money. Warren was a bit stressed by his money situation. He told Bill that he is earning well, but he has lots of responsibilities and expenses. With those and maintaining his lifestyle sucks out all his paycheck every month. Half of his paycheck is already going into monthly payments. He was thinking of switching his job again to get a pay raise, but then Warren was very surprised when he learned that Bill was still with the same company but had rolled back to a part-time contractor role. He was earning way less. He asked how Bill was able to maintain a good lifestyle despite less earnings. Then Bill told him about his investments and how he is already a multimillionaire, how he invested at the very least 20% of his income for about 20 years, and also dumped any bonuses he got from his workplace in his investment portfolio. Now, the interest from his portfolio is enough to sustain his lifestyle indefinitely. Warren was shocked. He doubted him and told him that he also tried the same, but he did not see the needle moving for a year. How can only 20% and some bonuses amount to millions of dollars? In reality, Warren is no different from the majority of people who do not understand the power of compounding, because those who do end up super rich, those who don't stay quote-unquote middle class. Bill then went on to tell Warren about Morgan Housel's principles in the Psychology of Money book. The most important thing to grow rich is to live below your means, save the difference, invest for the long term, and be diversified. Wealth creation, like what Bill has done, takes time. Time is the most powerful tool when it comes to investing. Not the money, not the rate of return, but time. Here's what Morgan means by it.
I think it's true that in most endeavors in life, there's a pretty quick payoff. So like if you go to the gym, you'll be sore tomorrow. Like there's an indication that something's working. If you're on like a new diet, you might feel different that day, the next day. It's a pretty quick thing. And so people take those payoff time periods, and when they apply it to investing, if they're new to investing, they might think, oh, I'm going to invest $1,000 and I'm going to check back next Wednesday and see how it's done. And then, or maybe I'll check back, 2 weeks from now and see what's done. 6 months feels like a long time. Because if you were going to the gym for 6 months and you saw no progress, you're like, you're doing something wrong here. But in investing, like we know, it's not intuitive for people, but this is an endeavor where you might lose money over a 10-year period. And that doesn't mean you did anything wrong. Investing is a very, very long endeavor. I think the closest example is like planting an oak tree. Like if you planted a seed in your backyard and checked it next Wednesday and you're like, oh, it doesn't work, it's a scam. You're like, no, it takes a long time. And the results are gonna be magnificent, but it's gonna take 50 years. And I think investing is really close to that. And it throws a lot of people off. By far the biggest problem for new investors is not understanding how much time is needed to put the odds of success in your favor. And it's not a month, it's not a year, it's something closer to 5 or 10 years before you're like, okay, if you've given it that much time, you should start to see most likely whether you're doing it right or wrong.
In the short term, it feels like nothing has changed, nothing has happened. But when you give compounding time to show its magic, the end result is nothing short of absolutely amazing. It has been seen time and time again that short-term investors or traders do earn a lot more returns in the short term, but they also easily lose a lot of money when things are not going well. There are very few people, like 1% to 2%, who actually are beating the market consistently. The key word here is consistent, because anyone can one-off get 30, 40, 50% returns, but if that person loses all of that and some more the next year, it means nothing. A lot of people make millions and even billions in every market cycle, but where are they? Most of them lose most of their money shortly after earning it. There's a saying, what goes up fast comes down fast. It applies to wealth more than anything else in the world. Slow money is always stable money. Fast money is fickle. In the short period, long-term investors always look like idiots. Whatever they are earning from their investments can easily be earned by putting up a lemonade stand over a weekend. But the magic happens when they keep at it for a considerable amount of time. 2, can average people get rich? Warren was somewhat getting that, but he still had a major doubt. Can the average person get rich? How can an average person, or even a minimum wage guy, who is finding it hard to meet his daily expenses, get rich? This again felt like a rich people's game to Warren. Bill did create a fortune for himself, but in hindsight, he must have been doing okay in his job if he was able to take out 1/5 of his salary every month for investing. Warren was barely able to hold his head above water even with his hefty paycheck. Bill told Warren that not much money is needed to get wealthy. As we also discussed in our last video, if you invest for 40 years, 95 to 97% of the money you will have will be growth. Only 3 to 5% will be the money you have put in. The rest will be growth. Bill also explained that the key lies in expenses rather than income. While income certainly helps, expenses play a more important role in saving and investing than income.
There's 2 parts of it, like income and expenses. And breaking that down, so much of modern spending is spending to show other people how much money that you have. And what you actually need to live a pretty happy, dignified life, if your expectations are low enough, is really not that much money. Particularly if you're a single person or you're a couple that's on the same page doing this, it's not tremendous. And I think people would be surprised how much modern spending is just like the keeping up with the Joneses effect of whether it's like not travel for enjoyment, but travel for Instagram photos to show people where you've traveled, and clothes and cars and whatnot is it's just, I always say, like, a lot of spending is the gap between your ego and your income. It's like so much of what we spend, not all of it, but so much of what we spend is just to signal to other people that you've made it. And if you can subtract at least part of that from your life, most people would be surprised at how little you can spend and live a happy, dignified life.
Bill then asked Warren, since he started his job 20 years ago, how were his expenses then and how are his expenses now? No matter how much and how fast Warren's salary increased, he still lived from paycheck to paycheck. Understanding dawned on Warren. When he started his career, he bought a car and rented a lavish apartment. When he got a promotion and raise, he upgraded his car and rented an even better apartment. When he switched a couple of jobs and his income almost doubled, he immediately bought an expensive house. That house was sucking up most of his new paycheck. He never gave his paycheck a chance to take a breather. When he climbed up higher in positions, he upgraded his house, car, vacations, clothes, restaurants, and all other things accordingly. If he had not, he would have easily saved massive amounts. After all, there is hardly any difference between iPhone 14 and iPhone 15. Heck, there is hardly any difference between iPhone 11 and iPhone 15 because both can do pretty much most of the stuff. Same with cars, houses, and all the other things. If he hadn't replaced his already working stuff, he would have certainly saved a fortune. Bill also explained that not upgrading doesn't mean not living a good life. If you have to buy new stuff, why not replace it rather than upgrade it? Why not trade a Toyota for a Toyota when you need to change the car? Why go for a BMW? Most people are self-obsessed and do not even remember what outdated stuff you own 10 seconds after meeting you. So who are you trying to impress? Then the real crux boils down to your requirements, and showing off loses its meaning. That made complete sense to Warren. He was stoked. Although he would have to make some lifestyle changes, but he wanted to start investing as soon as possible so that he could also change his family's fortune. 3. Hallmark of good investor. He had a barrage of questions for Bill. How to invest, where to invest, what is the better strategy? He also wanted to know that because he had already lost 20 years, can he make up for it? Can he invest in a place with a much higher return to catch up quickly? Bill replied that there is no free money out there. There is always a cost involved, even in passive investing. Even while passively investing in low-cost index funds, there is a cost of time and uncertainty. But before that, he explained how Warren could invest. There are many assets that he can invest in, like stocks, crypto, real estate, and even obscure things like watches, paintings, and baseball cards. And even in stocks, there are hundreds of ways to make money. Some people trade and some people invest. Some people choose individual stocks, while some people buy a group of stocks called mutual funds and index funds. People can also buy and sell products that are derived from the stock market, like futures and options. But then Bill explained that very early on, he realized that nothing beats consistency. Even seemingly small returns of 10 or 11% on index funds can be magnificent if given enough time. On the contrary, some avenues give 15, 20, 30% returns. Even doubling your money in a day is not unheard of, but they are not consistent. They go up fast, they go down fast. Sometimes they may give good profits, but some years they may even run negative. And the more the returns, the harder it is to succeed. For example, some products can multiply your wealth hundreds of times faster, but less than 1% of people are successfully getting those returns consistently. Most people, on the other hand, lose money more often than not. It is genuinely very hard to beat the market returns in the long run. Very few people are able to do that consistently. Additionally, it requires a person to make a full-time commitment to those endeavors. They have to actively look for opportunities on a regular basis. If someone is doing it part-time, they are deluding themselves. Then Bill told the story of Warren's namesake and the greatest investor of our times, Warren Buffett. Warren Buffett is one of the greatest investors, not because he is getting massive returns on his capital, but because he has been doing it for the last 80 years. In fact, he has averaged about 20% returns year on year during his entire 80-year career, which to some extent is good, but not the greatest. There are funds, groups, and individuals who have a better rate of returns, but no one has had it as long as Warren Buffett. His superpower is time. Then Bill told the case of Rick Guerin. In the 1960s or 70s, there was a third partner of Warren Buffett and the late Charlie Munger, Rick Guerin. They used to make investments together. Rick was a brilliant guy. All of them knew that they were going to be very rich. But the difference was that while Warren and Charlie were not in a hurry, Rick wanted to become rich quickly. He was over-leveraged, as in he borrowed a lot of money from the market to accelerate his wealth creation, and in mid-70s crash, he almost got wiped out. He He recovered, but not to the levels of Warren and Charlie ever again. So moving too fast may actually be counterproductive to your wealth. The right investment strategy is always a healthy mix of appropriate amounts of caution and optimism. Additionally, Bill told Warren that with the busy life and work situation of Warren, it is better to go with the passive investing approach, and that too automating most of it, so that there are no ifs and buts and mood swings in the equation. Bonus tip, number one big mistake that people make, but before going, Bill gave a bonus tip and cautioned Warren about the biggest reason why people don't make any money on investing, and why investing has such a bad rep with the people at large. But I'll let Morgan explain it here because he has done a fabulous job of explaining it.
I think there is a lot of money to be made in the money business. And because of that, there is a lot of bad advice. And there are a lot of people who look fairly reputable and sound fairly reputable who are, scam is the wrong word because that implies it's illegal. I think you're the lawyer, maybe you know. But there are a lot of people who I think mean well, but they operate in a system where the incentives push them to giving not the best advice and charging outrageous amounts for it.
Warren started living by these principles. He reduced his expenses, started living below his means, saved and invested in a low-cost index fund like Bill. He also did not get enticed by all the noise of making quick money, although his lifestyle certainly got impacted, but not by a lot. But he was able to save substantially more because he already had most of the things that he needed: car, house, and other stuff. Thus, he was able to save over 30% of his income to build his fortune. Nothing substantial happened for the first 5 years, but this time he was patient. By the 10th year, he was able to see that his wealth was growing at a visible pace. By year 15, his investment returns were matching his expenses. And by year 20, he too decided to roll back from his hectic job a bit, because his returns were exceeding his income now. Now, this is not an uncommon story. Millions of people around the globe are creating wealth using principles that Bill and Warren used. In fact, most of the wealth that is created around the world is created using these principles. Remember Ronald Reed I mentioned at the beginning of the video? He followed the same strategy. He was a minimum wage guy, and he saved a part of his paycheck throughout his life and invested it. He invested for over 40 years, and he ended up with over $8 million in the end. But there are a few things that are vital to a good investment portfolio. There is a lot of news and a lot of opinions on all the things around the world. However, there is one man who has experienced it all and come out as the most influential investor of our times. If you are curious to tap into his wisdom and really supercharge your wealth creation journey, click on this video here.